all know very well that the Sensex comprises 30 companies. When we talk about the Sensex, it actually means India's top 30 companies that are listed on the BSE. And now my first question. Do you happen to know when the Sensex actually started? Let me just show you right here on the screen. The Sensex officially began back in 1986. So if you go and look it up on Google, it was January 1st, 1986. I myself wasn't even born yet at that time. Although my own birthday actually falls on January 1st. But yes, the Sensex did indeed start in 1986. There were 30 companies included in the Sensex. But my next question is, how many of these 30 companies are still part of the Sensex today? I went ahead and asked Google the following question. How many companies are still there in Sensex since 1986?
So the result we got from this calculation here was only 4.
Only 4 companies have remained within the Sensex from 1986 right up until today. Just 4.
Meaning a total of 26 companies?
Either it ceased to exist or it was delisted from the Sensex, meaning it was out. But if you had invested your money in the Sensex, your funds would have automatically gone into the top 30 companies that are currently performing. If any company were to exit, your money would have been automatically reallocated from it to the company that is entering the Sensex.
So, what benefit would you have gained if you had invested in the Sensex? Companies may come and go, but your money would have grown steadily over the long term. Just take a look at the Sensex chart. If I show you the Sensex and you look at the maximum data we have available, you'll find that in 1986, the Sensex was valued at 561 rupees, but today it stands at 85,669. If I go to an online CAGR calculator, just to be precise, and I attempt to show you what the Sensex is currently trading at, almost 85,700 was reached, right? And how many years did that take? 90? No, wait. For this, I'll need a calculator. Let's see. 2025 minus 1986. That's 39 years. Okay, so it took us 39 years to get there. So the CAGR, the returns we got were 13.76. If your money grew at 30.76% CAGR, I'm giving you an example. You'll understand how significant this return is. So, if someone today invests 1 crore rupees, 1, 2, 3, 4, 5, 6, 7, and that's going to be for 39 years. 39, and you received a return of 13.76. All right, let's just write down 13.76 here. So I'm telling you, your investment only and only, I'm emphasizing only and only, you had made an investment of 1 crore rupees. 1, 2, 3, 4, 5, 6, 7. Now you can clearly see that your 1 crore rupees will become 1, 2, 3, 4, 5, 6, 7. 152 crore rupees, 1 crore will turn into 152
Even if I just mention 1 lakh, that 1 lakh rupees has now become 1 crore 52 lakh rupees. If someone had invested 1 lakh in the Sensex right from the beginning, they would have 1 crore 52 lakh today. If you also wish to make this kind of investment, then you should definitely consider an index fund.
Warren Buffett had a bet with a hedge fund manager. Post that he couldn't beat the S&P 500. Post the S&P 500 is an index. Post just like the Sensex is India's index. Post the S&P 500 is the US index.
This involves investing in 500 of the top companies. And Warren Buffett had actually won a bet because the individuals on Wall Street who were actively managing investment funds were attempting to outperform the market index. However, they ultimately failed to beat the index. The S&P 500, in contrast, generated significantly higher returns. And just consider this, we are discussing performance over a full decade. A bet was made in 2007 and Warren Buffett ultimately won. So you must understand that you need to do index investing. Index investing is also called passive investing because you're not actively thinking. You are investing in the indices on the NSE, these specific indices by name. ETFs follow these indices. And today's video, we will be discussing the top 10 ETFs that can help us achieve significant long-term growth in our lives and ensure that our investment portfolio becomes completely and thoroughly diversified. Now, I'll tell you about them one by one and you're going to really enjoy it. Just like Sensex, Nifty 50 is made up of the top 50 companies on the NSE.
So you can invest your money directly into Nifty ETFs. Now I will show you how to do it one by one, just like you would normally proceed. Nifty BS is good. This is Nifty's most popular ETF and its expense ratio is almost the lowest at 0.04%. Look at its returns. Its 5-year returns are seen to be above 100%. However, if I talk about Nifty's returns, normally I search for Nifty here and show you the Nifty index, then the index's returns for 5 years you can see are 92%. Your question now should be, is there an 11% higher return here? Because the ETF includes dividends, it gets reinvested and you will truly understand the power of dividend reinvesting in the long term. And what generally happens here, if you buy individual stocks, their dividends usually come into your bank account. But when you purchase ETFs, it doesn't come into your bank. So you also receive tax benefits. Your money gets invested in this ETF. ETFs provide higher returns. That's why Nifty Bees has given a return of 103% and Nifty's own return is 92%. So this is our first ETF where we can invest our money. Here I've written down the name Nifty Bees. For the second ETF, I'll simply search for midcap right here. The moment I search for midcap, I immediately find the midcap 50 ETF listed. Now observe that this particular ETF also has an expense ratio of just 0.05. And with this, my investment is being placed directly into midcap stocks. My money is being invested in the top 50 companies, specifically the top 50 midcap ones. The third ETF you need to write is small to 50. As soon as you move to the small to 50 fund, you'll notice an expense ratio of just 0.10, which is actually the lowest among all small cap options. And your investment here is spread across 250 different companies. That's why I've named it small to 50. Now consider this. When you invested your money in Nifty, you are putting it into large cap companies. But here, your funds are being allocated to mid cap companies. Here, your investment has gone into small cap funds. Now, you're almost completely diversified across the market. Now, what often happens is this. Many people often say that within the Nifty index, there are the top 50 companies, but they also want to invest in the next 50 companies that could potentially enter the Nifty and become large. For this, there is an index called Nifty Next 50. And you will get its ETF available simply under the name Next 50. You just need to search for Next 50. And its expense ratio is also remarkably low at just 0.05. You can easily check its 1-year return performance. This year, to be fair, it didn't perform. A 5-year return of 123%. That's more return than Nifty. The Nifty Next 50 is coming. What did you do now? Now, you have completely diversified your portfolio within the Indian market. Alright, if you've put your money into these 4, it means you've secured excellent exposure to the Indian market. By investing in these 4 specific ETFs, what exactly have we achieved? We have successfully made investments directly into India's leading companies. The question is, there will still be some companies that will gain momentum, so I want to invest in some of those companies too. Simply go and search for Momentum Mum 30, and once you type Momentum 30, you will find ICICI Prudential's Momentum 30 ETF right here. This particular ETF replicates the Nifty 200 Momentum 30 index. So now your capital is also invested in those stocks that are currently showing strong momentum. You see, by making just 5 strategic investments, you've successfully gained exposure to the entire Indian market.
The Indian market is covered. Now, let's talk about the international market.
So how exactly can you invest your money in the international market, you might ask, while you're sitting comfortably right here in India? Let me show you one particular option, which is known as Hang Seng Bees. So if I type Hang Seng into the search bar, you will clearly see its symbol displayed here. It's HN.
Yes, that is the person called GSN.
So G20, that means the Hang Seng Index. Your money is being invested directly into the companies that are listed within Hong Kong. If you look closely here, the return over the past 1 year has been 44%. Although its expense ratio is slightly higher, this is because you are getting this investment opportunity while sitting comfortably here in India in the ETFs of Hong Kong, or perhaps we should say China. So, if you wish to diversify your investments, you may consider investing in Hang Seng Bees. After that, if you're looking to invest your capital in an IT company based in China or Hong Kong, then if you search for MHK Tech, you'll discover that they are actively investing in such IT firms. Furthermore, if you examine their 1-year returns, you'll find an impressive 36% return. So that's MHK Tech. What is it that you have done now? You have taken exposure. You have invested in the listed Chinese companies that are based in Hong Kong. Now, if you believe that China is going to progress, then these companies will also move forward in the future. Now, apart from China, you might be thinking, sir, the United States market is going to grow even more. Yes, that is correct. Therefore, you certainly have the option to make an investment in the FANG index. You must go and search for the MiFang ETF. The returns generated by MiFang are going to look absolutely incredible to you. Since the US technology sector is currently booming, take a look at the MiFang ETF right here.